So let me take this opportunity to welcome you to our today's session. We are doing capital budgeting, and under the capital budgeting, we in the introductory part we discussed up to the the techniques of handling risk, and one of the key technique was the net present value, which we said is the difference between the cash inflow and the cash outflow. And during that time, we were able to discuss other methods of measuring risk. And today, I just want to focus on the areas of the computations because that is crucial as you wait for your exams. So another aspect of the computations, I would like to start with the I'll be able to start with a question tested on April 2023. April 2023, we have question number 1B. April 2023, question 1B. So let me share my questions. So here we have April. Question number 1B, you can be able to read it. You can proceed, please.
SIPO Limited is evaluating an investment project which requires the importation of a new machine at a cost of 3.7 million. The machine has a useful life of 6 years and a salvage value of 1 million. Additional information, note 1, the following additional cost will be incurred in relation to the machine. Modification cost, 1 million. Import duty, 900,000. Installation cost, 375,000. Freight charges, 225,000. Note 2, the machine is expected to increase the company's annual cash flow before tax as shown below. Year 1, 1.76 million. Year 2, 1.36 million. Year 3, 1.05 million. Year 4, 900,000. Year 5, 840,000. Year 6, 750,000. Note 3, the machine is to be fully depreciated over its useful life using the straight line method. Note 4, the corporate rate of tax is 30%, while the cost of capital is 10%. Note 5, the maximum acceptable payback period for the company for all capital project is 4 years. Required. Number 1, total initial cost. 2, annual net cash flow. 3, payback period of the machine. 4, net present value of the machine. 5, advise the company's management on whether to import the machine based on your results in B3 and B4 above.
Thank you so much. You remember when we were discussing about the theoretical part of the NPV, we said the NPV normally has 3 stages of the computations. 1, you have to be computing for the initial outlay. Number 2, we have to be getting our annual net cash flows. Then number 3, we have to be looking on the terminal cash flows. So I would like us to start with number 1, the computation of the initial outlay. The computation of the initial outlay. So in this case, when you look on the initial outlay, now, number 1, we are talking about initial outlay. I'm going just to be having 2 columns here, reducing our shillings to thousands, right? reducing your shillings to 1,000 like that. Then we are going to be starting with the cost of the machine, because we have been told that Simple Limited is evaluating an investment project which requires the importation of a new machine of a cost of 3.7 million. Now, the cost of the machine, we have been told is that 700. So we say, can we be able to add incidental costs? Can we be able to add our incidental cost? And that is what is in additional number one. The first one we can be able to see, we have modification costs. So modification cost, we have 1,000 here. The second one, we have import duty. So the import duty we have how much? The import duty we have 900. Number three, we have installation costs. Installation costs. Our installation costs will be able to around 375. Then we have freight charges here. I can see we have freight. The freight charges. Our freight charges is 225,000. 225,000. So how much is this? 225,000. How much is this? So you take your calculator here. You tell me is 1,000 plus 900 plus 375 plus 225. Getting 2,500. Getting 2,500. Getting 2,500. That is basically called that is the incidental cost. So we need to get the total cost of the machine. The total cost of the machine. You take that 7 plus the incidental cost. So plus that 700, getting around 6,200, right? You remember here down, we talked about we left the NPV of the old machine. We are not replacing, and that part is not relevant right now. So in this case, we can just be able to add, if it is there, we can be able to add investments in working capital. So if it is not provided, you just take the current assets minus the current liabilities. Then in our case, it is not there. So what is your initial outlay? We say our initial outlay is 6,200. That is your initial outlay. That is your initial outlay. Step number 2, we normally want to compute the annual net cash flows. We can be able to calculate your annual net cash flows. So I can see there in note number 2, we are discussing about an increase in the cash flows, right? An increase in the cash flows. So in the annual net cash flows, when you look on those cash flows, which we already be given, they are in lump sum modes, because already you can see they are not the same for the 6 years. So we are going to be taking the number of years. We have year 1, year 2, year 3, year 4, year 5, and year 6. Something looking like this. So when you talk about an increase in the cash flow, it means that is your earning before depreciation and taxes. The earning before depreciation, sometimes it might be the savings. When you go to the market and you save something, for example, you are budgeting to buy a shirt for 1,500 and then you buy it at 1,000. You have saved 500. That 500 is an income to you. So in this case, that becomes the 500 becomes your earning before depreciation taxes, right? In our case there, the year 1 is 1,760. Year 2, we have 1,360. Year 3, we have 1,050. This has been 900 in year 4. Year 5, we have 840. And then year 6, we have 750. 750 there. Right? We can be able to less our taxes fast. I can see we are being given at the rate of 30%. The taxes at the rate of 30%. So you take your calculator, 30% of 1750. So 176 times 3, getting 528 here.
Question.
Okay. 1360 times 0.3, getting 408. Okay.
I have a question.
Yes.
The investment in WC that you added up there, I'm just asking, what can you explain that to me? It's the one you've said it's not relevant to us.
Come again?
The investment in WC, the one added after total cost of machine.
Oh,
Hello?
The investment in the working capital, it is not in the question. We shall do the questions with the investment in the working capital. I said, in most cases, you may find a question it is not provided. Then you can take the current assets minus the current liabilities. You can get the working capital. This is the formula for the working capital. But in this case, in this question, it is not provided. So, upaswi kushinda ukitafuta when it is not there. So 900 times 0.3, I hope I have answered your question, is 270. Then we have 84 times 3, getting 522. 252, sorry. 252. Then we have 75 times 3, getting 225. Then we add, we normally add depreciation tax sheets. How do we normally calculate the depreciation tax sheets? We normally take the total costs of the machine. We subtract the scrap. You divide by the number of years. Right? Then you multiply by the tax rate. In our case, it's 30%. So if I do the first year, for example, the total cost of the machine, you don't take the initial, you normally take the total cost of the machine. So in our case here is 6,200 minus 6,200 minus, what is the scrap value from the question? I can see we are being told that the machine has a useful life of 6 years and a salvage value of 1 million. In our case is 1,000 divided by 6 years. Okay, then you multiply by 0.3. Multiply by 0.3. So this is 5,200. 5,200 divided by 6. 5,200 divided by 6 times 0.3. We are getting 260. So 260, you had across. 260. 260. Right? 260. So what are we getting down here? What we are getting down there is what we are calling the annual net cash flows. The annual net cash flows, we have 1760 minus 528 plus 260. The first one is 1492. The second year will be 1360 minus 408 plus 260. Getting 1212. We have 1050 minus 315 plus 260. We are getting 995. We have here 4. 900 minus 270 plus 260. Getting around 890. Then we have another year there. We have 840. minus 252 plus 260, getting 848. Then the last year, I don't know whether you are able to see there. I will just check. 850 minus 225 plus 260. We are getting 785. 785 there. 785. 785. 785 there. Okay. Now, step number 3 is about getting the terminal cash flows. So the terminal cash flows, how do we normally get our terminal cash flows? I'm going to be having a column here for Kenya shillings in thousands of shillings. So we normally take the scrap value of the new machine. In our case, I can see the scrap value we had is 1,000. We less the scrap value of old machine, the scrap value of the old machine, which we don't have. Then we can add, if we have the investments in working capital, the investment in working capital, we don't have it. So how much is your terminal cash flow? The terminal cash flow in our case is 1,000. Now, you have already done all this. Those are the 3 steps. Now we want to compute the NPV. So if you want to compute the NPV, take the number of years. Right? We have year 1, year 2, year 3, year 4, year 5, and then year 6 is mara mbili. The cash flow for year 6 we are going to be getting twice. What does this mean? It means the cash flows that you are going to be generating up to year 6 will be available, and then we are going to be selling. For example, you can be taking a vehicle for a certain project. You purchased it. Then the purchase, for example, is 3 million. During the period of the end of the project, which you purchased the vehicle for, you want to sell it at 3 million. So there is a revenue which has been generating over the years. There is a revenue that vehicle was generating over the years for the period in which you stated in your, and then there is a period at the end where you are saying it will be ending the year 6. How much will it be? So that is what we know. We are discussing about the terminal cash flow. Let us take our cash flows. So the first one is 1492. The second one is 1212. The third one is 995. 890. We have 848. We have 785. Then the last one is 1,000. Now, we discount using the cost of capital. In our question, the cost of capital is how much? The cost of capital there, in note number 4, we have been told it is 10%. Then you are going to be getting our present values. I said, when the cash flow, they don't look the same. When you look on these cash flows, they are not looking similar. They are not regular cash flows. So these are irregular. When they are irregular, it means they are lump sum. So what is the formula for the lump sum which we are going to be using? We say we can be able to use 1 plus R, we raise for a negative n. There are people who like to use tables, but I like to use formulas. So how much will be the first one? So the first one will be 1 point, because it is 1 plus our rate, which is 10%. We raise with the number of a year. So the first one will be 1.1. We raise to power negative 1. Getting 0.9091. We go to the second one. Getting 0.86. 0.82. 8264. We go to the third one. 0.75. 13. Number 4. We are going to be getting 0.6830. We have here 5. We are getting 0.6209. Then we have here 6. 0.5645. 0.5645. 0.5645. That is how you're going to be getting the discount factors. To get your present values, take your cash flow, you multiply by the discount factors. So it will be 1492 times 0.9091, getting 1356. Allow me to put in whole numbers. 0.8264. We multiply by 1212, getting 1002. The third one will be 995. We multiply by 0.7513, getting 748. The other one will be, okay, you are able to see, 890. We multiply by 0.6830, getting 608. The other one will be 848. We multiply it with 0.6209, getting 527. 785 times 0.5645, getting 443. Then 0.5645, we multiply by 1,000, we get 565. So how much is the present value of the cash inflow? The present value of the cash inflow. The present value of the cash inflow is how much? Very simple. You just need to do your summation. 1356 plus 1,002 plus 748, right? Plus 608 plus 527 plus 443 plus 565. We are getting 5249. 5249. Then we less our initial claim. How much is our initial claim? You know it is 6,200. How much is your NPV? Right? So your answer now, you subtract 6,200. We get 951 negative. So you remember we said under the acceptance rule, we said one thing here. Under the acceptance rule, we said what? We said when the NPV is negative, the project is going to be rejected. When the NPV is positive, the project will be accepted. When the NPV is equal to 0, the project might be. The organization can be able to take the risk, right? The organization can be able to take the risk. So how are you going to be recommending there? How are you going to be recommending as required there? Very easy there. This is what you are going to say. This is what you have to say. So you can be able to say not number 5. I think it should be number 5. We say the importation is not recommended. The importation is not recommended since NPV is negative. The importation is not recommended since your NPV is negative. Any question? Any question there? No question?
Yes.
Have you understood?
For the payback period.
Sorry?
Question.
I'm not
Hello?
getting you.
I'm saying I have a question.
Yes.
For the payback period.
Uh-huh.
Which formula did you use to calculate the payback period?
Very good, very good, very good. Now, there is a question there regarding to payback period. Payback. The computation of the payback period, right? The computation of the payback period. So this is what you do here. So to get your payback period, you have to be looking on whether the cash flows, your cash flows are regular or irregular. So in our case here, we are dealing with irregular cash flows. So what are we supposed to do? We are supposed to accumulate the cash flows until you attain your initial thing. Let us take the number of years here. We have the number of years, right? We have our cash flows. Then we have cumulative cash flows. Cumulative cash flow there. We have year one, where we have 1492. So when we are accumulating, we are starting with 1492. We go to year two. We are having the cash flow of 1212. So 1492 plus 1212 is how much? 1492 plus 1212, getting 2704. We go to year three. Remember the initial play is 6200. Year three, we have 995 plus 995, getting that 699. We are yet to attain 6200. We go to year four. Under year four, we have 890. So we add our 890 here, getting 4589. We go to year five. Year five, how much do we have? 785. So we add 785 here, getting 5374. We go to year six now. Under year six, we have 785. But do we need 785?
Year five.
Sorry?
Year five is, I thought year five is 848.
Oh, year five is 848, sorry. So 4589 plus 848, getting 5437. We are yet to attain 62, but we may not require 785, right? So can we put 6200 here? And tell me, how much cash flow do we require at year six? We say, if you take 6200 minus my answer, which is 5437, you just need 763 and not 785. You just need 763 and not 785. So what will be your payback period? You'll say you have used the rule of 5 years. Plus, to get now the period required to generate 763, you just need to take 763, you divide by the total generated in that year, 785. So how much is this? So you say 763 divided by 785, getting 0.97. So you require the 5.97 years. 5.97 years. 5.97 years. 5.97 years. Any question? That is how you do the payback period. Right? The payback period. That is how you do the payback period. Let me just finish something here so that I can give you an assignment. There is an assignment I want to give you. So let me do something here. So if this examiner was asking you to calculate the PI, the profitability index, If this examiner was asking you to calculate the profitability index, what will it be? You say, we are going to be taking the present value of the cash inflows. You divide it by what? Your initial outlay. If the examiner was asking you to calculate the present value of the cash inflows, to calculate the PI, the profitability index. So in this case, you just need to take the present value of the cash inflow. You have gotten it here, which will be 5249. You divide it by 6200. You divide it by 6200. How much it is? So in this case, you say 5249 divided by 6200. We are getting 0.85. 0.85. That is how you compute the PI, the profitability index. The profitability index, right? That is how you calculate the profitability index. Okay. So how do we normally, under the acceptance rule of the profitability index, what have we said in our notes? We said in our notes, we said that a project whose PI is greater than 1 is accepted, while a project whose PI is less than 1 is rejected. And you can see, you can be able to reject our project because the PI is less than 1. And we say there down, the project whose PI is equal to 1 may be accepted. But we say it, in other cases, we normally say, where, for example, you'll be able to do your computation for IRR, the IRR, when the IRR, the project when the IRR is greater than the cost of capital, remember we normally accept, when the PI is, when the NPV is positive and the PI is equal to 1, right? So in simple terms, it means when the NPV is positive, you're going to be getting positive results with the PI. But when the NPV is negative, here, under the NPV, still when you do with the PI, it will be rejected. The project will be rejected. That is the cases there. Then there is the last thing, which I just wanted to use this illustration for better understanding, and then I will just be able to move on to other questions. There is another thing here, which an examiner might be putting in place, right? That is a PI now. Yeah. We might be having problems with the modified. Let me talk about the modified internal rate of return. This is normally called MIRR. Okay. How do you normally calculate your MIRR? Sorry. How do you normally calculate our MIRR? We say, to get our MIRR, we normally take n, the root of n, which is the number of years, or the project's economic life. We normally take the cumulative compounded cash flows, compounded cash flows. We divide all of these. We divide that by initial claim. Then we subtract 1. We subtract 1. That is how you normally get the MIRR. Now, take the number of years now. We are using the current illustration. Take the number of years. We have 1, 2, 3, 4, 5, 6, 6. Then we have our cash flows. So how much is your cash flows? 1492, 1212. We have 995. We have 890. We have 848. We have 785. Then we have 1,000. The discount factor, right? Remember your discount factor. The discount factor of ours is 10. But remember, we are compounding. We are not discounting. So in this case, we are going to be using, remember this is a lump sum. So we are going to be using P5, the present value of the cash inflows. which is as 10%. Right? And then you're going to be getting the future values. You're going to be getting the future values. The future value. Remember, when you are doing the MIRR, you have to make an assumption that the values are normally deposited at the end of the accounting period. For example, tunasema hii pesa tuliweka mwisho wa mwaka unless otherwise stated. So in this case, it means how many, because our project takes 5 years, how many period does this require to stay in the account? How many? How many periods? Now, we have 6 years, but if peso may deposit at the end of year 1, it will stay in the account for how long? It will stay in the account for, we talk about 5 years. So you say 1.1, you raised to power 5. Because the accounts will be staying there for 5 years. What about the second one? It will be 1.10, we raised to power 4. The third one will be 1.10, we raised to power 3. 1.10, we raised to power 2. 1.10, we raised to power 1. And then these ones have 1.10, we raised to power 0. 1.10, we raised to power 0. Higher. How much are you getting here? These ones you are getting 1. Anything raised to power 0 is 1. So this one will be 785 here. And this one will be 1,000. Okay. Now, 848 times 1.1. I hope we are together there. 848 times 1.1. We are getting 933. Yeah. 1.1, we raised power 2 times 890. We get 1077. I'm putting in all numbers. Yeah. 1.1, we raised power 3 times 995. Getting 1324. Okay. The other one will be 1.1, we raised to 4 times 1212. Getting 1774. Then the first one will be 1.1 raised to power 5. We multiply by 1492. We are getting 2403. 2403. 2403. 2403, right? So what is the cumulative compounded cash flows? What is the cumulative compounded cash flows? You do your summation. So the first one will be 2403 plus 1774 plus 1324 plus 1077 plus 933 plus 785 plus 1,000. We are getting 9296. Something closer to that. 9296. 9296. That is how you do MIRR. Okay. That is how you do your MIRR, right? Once you finish doing so, once you finish doing that, okay, you come here and you tell me, to get my MIRR, which you are going to be taking the number of years. Our N we said is the number of years. So it will be 6, the root of what? The cumulative now, which you have gotten 9296. You divide it by your initial outlay. Your initial outlay was 6,200. 6,200. Do all of these. Then we subtract 1. Okay, very simple. So let us start with 9296. Divide by 6,200. Okay. Then we have the number of years, which is 6. You press it. Then you press shift from your keyboard. Shift. There is a sign like this in your calculator. There is that sign in your calculator. Shift that sign. Right. Shift and that sign. Then it means you're going to be having 6 x, the root of our answer. Right? Then we subtract 1, which you are going to be getting something closer to 6.98. 6.98%. 6.98%. 6.98%. That is how the questions of modified internal rate of return are done. The PI are done. We have done the discounted payback periods, right? The discounted. Have we done the discounted payback periods? Let me see.
Question.
Yes.
Question.
Yes, continue.
For the present value interest factor for the cumulative compounded cash flows, why are we starting with 5 with a power of 5 for the year 1 and then going down like that?
Thank you very much. You might not be able to get what I said. I said another compounding. We assume, unless otherwise stated, we assume this money was deposited at the end of the accounting year. So if, for example, we deposit 1492,000 at the end of year 1, they will stay in that account for how many years? Year 2, year 3, year 4, year 5, year 6. Those are 5 years.
Okay.
And they will be able to mature. That is where the 5 is coming.
But for the other calculation, for the one on the right, they're calculating the present value for that 1 year.
Sorry?
For the working on the right, where we are also calculating the present value, we are doing for each, well, we are doing the opposite of the cumulative, yes? The one we were doing before on your right.
These are the present values. You take the future.
Completely on your right, the other end of the board.
Yeah, this is the opposite. That is the opposite. Just to revisit the time value of money, we have a very good analysis there for the future, the present values, and you will be well guided there. You'll be well guided. So there is a question which I just want to give you as an assignment. There is a question there, and you have to do it because it's for your own benefits. So this question is here. I have the question here with you. So the question itself is here. So already we have been given the MAPEMA, we have been given the annual cash flows for both projects, project X and Y. They have given you the initial investment, that is your initial outlay. Then they have given you the cash flows for both projects. The firm's cost of capital is at 15%. Then the cash flows accrue at the end of each year. So in this case, they're asking you for the discounted payback periods. Okay. The discounted payback period, the modified internal rate of return, which we have already done here. And then we have, what else there? They are asking you for, what is the requirement number 3? Number 3, they're asking for profitability index, and that is what I was explaining here. So I would like you to try and do that question. Just try to do that question. Just try. So this question was tested on December 2023. It is a pilot paper. December 2023. Is it a pilot? No, it is not. Not a pilot paper there. December 2023. Question number 1B. December 2023, question 1B. I would like to see how you are going to be interpreting this question. Now, let me proceed with my analysis for today. I don't know whether wenzenu wako maandamano, but let us proceed. Okay. Now, there is a question here, which is a different set with whatever we have learned. CK, you can be able to read for us, unless you have issues with your network. Question 2B, May 2018. May 2018. Is CK around?
I think he has issues. He keeps disconnecting.
Okay, you all can proceed. Proceed.
Kubusa Limited is contemplating the acquisition of a new, I can't see because the cursor is on the other tab. Kubusa Limited is contemplating the acquisition of a new machine to replace the one currently being used in production process. The existing machine was acquired 2 years ago at a cost of 8 million shillings. The existing machine was estimated to have a useful life of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.5 million. The existing machine can be disposed of now at 4 million shillings. The new machine is expected to cost 12.56 million with a salvage value of 4 million shillings at the end of its useful life of 5 years. The new machine will also require an additional investment in working capital of 2.6 million at the start of its useful life, which will, however, be recovered at the end of its useful life.
Continue.
Scroll up. Please scroll up. I can't see there. The new machine is expected to cost, oh no, sorry. The following information relates to the estimated earnings before depreciation and tax, in brackets EBDT, over the coming 5-year period for the two machines. Year 1, 5.4 million. For the existing machine, 3.2 million. Year 2, 5.4 new machine, 2.8 existing machine. Year 3, 5.4 new machine, existing machine, 3 million. Year 4, 5.4 million new machine, 2.4 existing machine. Year 5, 5.4 new machine, 2 million existing machine. Kubusa Limited cost of capital is 13%. The company applies straight line method of depreciation. The corporate tax is 30%. Required, using the net present value technique, advise the management of Kubusa Limited on whether to replace the existing machine with the new machine.
Thank you so much. And see there are people over there which are a bit disturbed by the network. Let me see how things are. Today we are having issues with network, and when I'm not using my Wi-Fi, don't know what might be the challenge with the current regime. But let me explain the question. There is an aspect there, and this is the concept in which examiners are using so much to manipulate your mind. They are giving you the new machine and the existing. Do you know the difference between the cash flows of a new machine and the existing? Because that is a saving. When you are bringing the new machine, it is going to be increasing the annual before the earnings before depreciation and taxes. The difference, which we are going to be calling the increase right? The increase in the earning before depreciation and tax. The difference now is the one that you are going to be using at a start point for the computation of the annual net cash flows. The difference between the two. We're going to now to be doing those adjustments. But let me now start the questions from the first stage for the computation of the net present value. So let me start with the first side of doing this question. Very simple. Now, number one of this question, we are discussing about initial yield, right? The initial yield. You just need to have two columns here of Kenya shillings, right? Two columns of Kenya shillings there. Then let us look on the cost of the machine. How much is the cost of the machine? As per the question, how much is the cost of the machine? Right? They have said now today it is, I don't know, it is through the Mandamano or something, but things are not good in terms of the network. So the existing machine was acquired 2 years ago at a cost of 8. Yes?
Sorry, which month and year is the paper?
I'm not getting
Which month and year is the paper?
Come again?
The month and the year of the month and the year of the paper. I want to open it from my side.
Or you cannot see it through my board?
I want the question. I want to open it maybe on my loft.
It is May 2018, question 2B.
Okay.
So what is the cost of the new machine now? Now, the cost of the new machine, let us just read the question there. In the paragraph 2, we are being told the new machine is expected to cost 12.56. That is around 12,560. 12,560 with a salvage value of 4 million Kenya shillings. We shall be able to use that later. Now, let us look at, because we might be having a disposal. I have seen we have a disposal here of the old machine, right? We're being told we have an old machine there. So we are being told that the new machine is expected to cost 12 with a salvage value of 4 million at the end of its useful life of 5 years, right? Now, we are being given a lot of information, but let me go up there. You're being told that Kubusa Limited is contemplating the acquisition of the new machine to replace the one currently being used in production process. And we have been told the existing machine was acquired 2 years ago at a cost of 8 million Kenya shillings, right? The existing machine was estimated to have a use 5 years. So we have been told over critical analysis of the machine now show that the machine is usable for the next 5 years with a salvage value of 1.5 million. So the existing machine can be disposed now at 4 million. So let us less here. Let us less the disposal value of old machine. So the disposal value of the old machine is 4,000. The disposal is 4,000 there. Now, can we be able to look, because here, some of you might be looking at where are the incidental, they are not there. Even when you are reading the question, I did not hear about any incremental cost or something, incidental cost here. And therefore they are irrelevant. Now, let us focus on the tax on gain, because here we are replacing. So let us look on the tax on gain, stock loss, on disposal. Because if we could be having the increment, or they could be between the cost of the machine and the disposal, zingekuwa hapo katikati. So that is the area where they could be in. Now, let us calculate the tax on gain stroke loss of disposal, the first thing that you have to be checking is taking the disposal value of old machine. The disposal value of the old machine, in our case, is 4,000 here, right? Then you normally deduct what? We normally deduct the net book value of old machine. The net book value of the old machine. How do we normally calculate the net book value? The way the Mr. Cho is calculating for you, 8,000 minus, this is the cost, minus the depreciation, you get the net book value, right? So in our case here, it is 8,000. Let us calculate the depreciation. It is 8,000. Correct. Minus, this machine does not have a scrap, but it is staying for 5 years, right? Then we multiply by, we have been told that the machine was acquired 2 years ago. So remember, when you divide by 5 years, you are going to be getting the depreciation per year. Then you multiply by the number of years the machine has been in use, which is 2 years. Okay, because we have been told the existing was estimated to have a useful life of 5 years with no salvage. That is why I'm putting here 0. It doesn't have a resale value. So it will be 8,000. Divided by 5, you get a depreciation per year. Then you multiply by 2, getting that 200. So once you take 8,000 minus 32, we get 4,800. Okay. Once you get 4,800, what are we getting here? We are getting the tax on loss on disposal. The tax on loss on disposal. A tax that you are going to be taking 800, which is a difference between 4,000 minus 4,800. Then we multiply with the tax rate of 30%, getting around 240, which will be negative. Any question at that? Thanks. The disposal value of the old machine is 4,000. Then you let the net book value of the old machine. You take 8,000 minus the depreciation, whereby we have to be taking the cost of the machine minus the scrap value, which is 0 in our case. We divide by the number of years, which is 5. We get a depreciation per year. Once you get a depreciation per year, you multiply with 2 years. Multiply with 2 years. So once you take 8,000 minus your depreciation, right, which is around that 200 now, which is that 200, you are going to be getting 48. So once you take 4,000 minus 48, you get the tax on loss of disposal, which is 800. Then you multiply by 30%. We get a loss of this. So in that point, what are we supposed to be getting now? We get the net cost. The net cost of the new machine. The net cost of new machine. How much it is? So we are going to be having 12,560 minus 4,000 minus 240. You are getting 8320. 8320. 8320. Then now we are going to be adding investments in working capital. How much is the investment in the working capital? We say our investment in working capital, we can just be able to check from the question. There is somewhere in paragraph 2. The examiner was saying the new machine is expected to cost 12,560 million with a salvage value of 4 million at the end of its useful life of 5 years. So the new machine will also require additional investment in the working capital of 2.6 million, which is 2,600 in our case. So how much is the initial outlay here? How much is the initial outlay? So plus 2,600, getting 10,920. 10,920. 10,920. 10,920. Now, that is initial. Number 2 here, very critical. We need to get the annual net cash flows. Unless there is a question at that point. So when you look on the annual net cash flows, I can be able to see the new machine as the same cash flows, but the whole does different, right? So we are going to be putting the number of years in our row-wise. Then we are going to be taking the increase in earning before depreciation and taxes. Just assume that the number of years zangu nimelimit to thousands. So the first thing that you have to be doing is to look for the differences between the new machine and the existing. So this one will be 5,400 minus 3,200. Getting 2,200 here. Year 2, we have 5,400 minus 2,800. Getting 26. Okay. The other one will be 5,400 minus 3,000, which is 2,400. Yeah. The other one will be 24, that is 3,000. Then the last one will be 54 minus 2, getting that 400. Okay, that 400. Now, once you get that now, you need to less your taxes. Just less your tax there. So the tax will be at the rate of 30%. Kuna mahali ukifika the advanced level, I will be able to say, when the tax is not provided, then don't, right? In most cases in advanced, when the tax is not provided, then you cannot be able to put your 30% here. So this will be 660. This one will be 780. You can confirm. This will be 720. This one will be 900. Then the first one will be around 1020. You can be able to confirm that. You can be able to confirm that. Now, after you do so, I need you to add depreciation tax shields. And this depreciation tax shield we normally take for the new minus the old, right? So in this case, let us calculate the depreciation tax shield for the new machine. The depreciation tax shield for the new machine, how much is it? Now, in this case, you can be able to compute by yourself. What is the cost of the new machine? I can be able to see somewhere here. The cost of the machine, it is 12,560. So I just need to take 12,560 minus. Our new machine has a scrap value? We say yes. Where? In the paragraph 2, we are being told the new machine is expected to cost 12,560 with a salvage value of 4,000 here. You divide by the number of years. How many years? With the number of 5 years. Then all of these we multiply by 30%. How much is it? So 12,560 minus 4,000 divided by 5 times 0.3. Getting 5. Let me talk about 514. No. It should not be having. Let us first look at the depreciation itself, which is 1712. The depreciation first. The depreciation first. Now, from there, let us get for the old machine. For the old machine. So for the old machine will be how much? Remember here, after the 2 years, you calculated the depreciation tax shield for the 2 years. So you remember you were able to get something there. So the net book value of this machine after 2 years will be 48. Minus. Na pale juu wameongea stories of the new machine. They are saying a critical analysis of the machine now show that the machine is usable for the next 5 years with a salvage value of 1,500. So how much is the depreciation here? How much is the depreciation? We say 4,800 minus 15. Who doesn't know where the 4,800 is coming? Who doesn't know? Who doesn't know where the 4,800 is coming from? So to get your depreciation tax shield, we just need to get the difference between the new and old depreciations. So 1712 minus 660, we get 1052 times 0.3. times 0.3. We are getting 316. Let me just put my depreciation here. I can be able to add depreciation fractions. 316, 316, 316, 316, 316. So what is my annual net cash flows? How much is my annual net cash flow? 2200 minus 660 plus 316, getting 1856. The second year will be 2600 minus 780 plus 316, getting 2136. Yeah. The third year will be 2400. 2400 minus 720 plus 316, getting 1996. The fourth year will be 3000 minus 900 plus 316, 2416. Then the other one will be 3400 minus 1020 minus 316, 2064. 2064. That is what you do. That is what you do. Those are your annual net cash flows. Then the last thing that you need to compute here, it is your terminal cash flow. So how much is my terminal cash flow? I said, just need to have a column of Kenya shillings there. We look on the scrap value of new machine. The scrap value of the new machine, we have said it is 4,000. We less the scrap value of the old machine. The scrap value of the old machine is how much? The scrap value of the old machine, we have talked about 1,500. Then we add investment in working capital. The investment in working capital was about 2,600. So how much it is? How much is our terminal cash flows? So you take 4,000 minus 1,500 plus 2,600, getting 51. 5,100 there. Now, let us compute our NPV now. We take the number of years. The number of years that we have. So we have only, are they 5 years? So year 1, year 2, year 3, year 4, and year 5. Year 5, they are 2. We have the cash flows. So the cash flows, we have 1856, 2136, 1996. We have 2416, 2064, then 5100. Discount factor at 15%, we get our present values. Correct? We up to the point, yes. So in this case, the discount factor, I think it should be, is it 13 or 15? Let me see. I'll be guessing my own things. The discount factor of ours is how much? 13, sorry. It should be 13%. And because this is lump sum, I say, it's very important for us to use formulas. So allow me to use the formulas. You can be able to use our formulas. So the first one would be 1.13, we raise for a -1. Getting 0.8850. The second one would be 0.7831. The third one will be 0.6931. The other one will be number 4, 0.6133. Number 5, 0.5428. And this one will be the same. Judy. 1856 now, you multiply the cash flows with the discount factors, right? So 1856, you multiply by 0.8850. 1643, 0.7831, you multiply by 2136, getting 1673. The other one will be 1996 times 0.6931. So 1383. The other one will be 0.6133 multiplied by 2416, 1482. The other one will be 2064, you multiply by 0.5428, get 1120. Then the last one will be 5100 times 0.5428. We are getting 2768. What is your present value of the cash inflow? The present value of the cash inflow is out. So we say 1643 plus 1673 plus 1383. 1383 plus 1482 plus 1120 plus 2768. We are getting 10,069. We less our initial claim. How much is our initial claim? How much is your initial claim? How much is your initial claim? We say our initial claim was how much? Somewhere 10,920. How much is your NPV? Judy, you can give us the conclusion. What can you be able to advise? What can you be able to advise? Eric? Eric, what can you advise? What is the advice can you give to this organization? That is what I'm asking. Nobody is aware of anything. Sorry for that. Sorry. So I was asking, how can you be able to advise there? Can you be able to advise? So in this case, very simple, yeah? Very simple. You can say advice. Let me just write here because there is something I want to do. The existing machine, sorry, the existing machine should not be replaced. The existing machine should not be replaced. Should not be replaced. Should not be replaced since it will reduce the shareholders' wealth. Since it will be able to reduce the shareholders' wealth. The existing machine should not be replaced since it will be, or it will be able to reduce. You can see the NPV is negative, right? Now, let us look on the aspect of the computation using the same question of IRR. How do we normally compute our IRR? And you know, when you're computing the IRR, we normally take the lower rate plus what? The lower rates. We take the NPV of lower rates. We divide by differences in NPVs, the differences in NPVs. Then here we multiply by higher rate minus the higher rate minus the lower rate. Now, which criteria can you use now? Because when you're calculating the IRR, I remember through the notes that we wrote there, or the note that we have, we say the IRR is the discount factor at which the NPV should be equal to 0. So the discount factor that equal to the present value of the cash inflows to the initial place. You have these notes. So the first step is basically to compute the NPV as how we have done here. That is the first step for the computation of the internal rate of return. But we are let me change my network, please. 1 minute. So let us resume. I was discussing about the issues of the IRR, and I say the first step is to calculate the project's NPV as how we have done here. Then after you do that computation, we are saying if the NPV is positive, it means that the cost of capital is lower than the IRR, and we therefore increase the cost of capital using the trial and error experiments. Now, the trial and error, it means if this was positive, we can be able to shift this to 26% or 30. The IRR everyone should be getting is or as based on the, so we normally calculate the NPV aiming to get the negative. Now, in our case here, we are computing now to get a positive because this is negative. Now we want to get a positive one. So in this case, we are saying the opposite will be able to apply if the NPV was negative, and we therefore interpolate the rates between the two NPVs, whether it is negative or positive. Now, we just want to look at is it possible to get when we have a negative NPV? How do we normally calculate our IRR? Very simple here. I want to reduce my cost of capital now because when it is negative here, it means you have to be taking a lower rate. A lower rate. Let me talk about the number of years now here. The number of years. The number of years. Cash flows. Discount factor. I can take 5%. Then we get our present values. So we have 1, 2, 3, 4, 5, 5. Then we have 1856, 2136, 1996, 2416. We have 2064. And then we have 5100. So the discount factors of ours, let us use the formula. 1 plus r we raise for negative n. For 5, someone might use 4, another one might use 7. But our goal is to get our positive NPV in this case. If this was a positive, we can increase the discount factor higher. That is why I said you can take 30% or something. Now, in our case here, we are just taking 1.05, we raised for negative 1, getting 0.95, 0.9523, 24. We go to year 2. 0.90, 70, go to year 3, 0.86, 38, year 4, 0.82, 27, sorry. Then we go to year 5 now, 0.78, 0.78, 0.7835. Then you multiply the cash flow, the discount factor to get the present values. 1856. We multiply by 0.9524. Getting 1768. 0.9070 we multiply by 2136. getting 1937, 0.8638, multiplied by 1996, getting 1724, 2416 times 0.8227, getting 1988, 0.7835, we multiply it by 2064, getting 1617, 0.7835, we multiply by 5100. They're getting 39. So what is your present value of the cash inflow? So it will be 1768 plus 1937 plus 1724 plus 1988 plus 1617 plus 3996. We are getting 13,030. Let's do initially. Our initially was 10,920. What is your NPV now? So the NPV will be 2110. Now, let us take the IRR of the lower rates. The IRR of the lower rates. So in this case, we say the lower rate of ours is 5. It is 5. The NPV of the lower rate, which is 2110. We divide by the difference in the NPV. You normally take the negative minus the negatives. So it will be 2110 minus 851. Then here, we multiply here by the IR rate, which was 13 minus 5. 13 minus 5. 13 minus 5. 13 minus 5. So how much it is? So we say 2110 minus is positive plus 851. So 2110 divided by answer. We multiply by the difference here. Is it 8? Should be 8. Multiply by 8. Then we add our 5 here. Getting 10 points. 10.7. This will be 10.7%. So when you look at your IRR, it's lower than the cost of capital, and therefore the project should be rejected. That is under the acceptance rule. The IRR now, you can see it is lower than this. And that is why nilikwambia, kama NPV is negative, it means even if you are using the IRR, you're going to be getting a negative. The same advice you are giving, it is the same. You should be using IRR, whether you're using the PI and so on. So that is how the project should be rejected, because the 10.7% is less than 13%, which is the project's cost of capital, which is the project's cost of capital. I have not finished doing the questions regarding to this topic, and therefore we'll be able to request suggest a day over the weekend. We can just meet for around 2 hours. We finish up with the topic. What I said earlier is I will be able to share the questions or the videos regarding to the ratio analysis. The videos, you just go through them so that our next week, before the closure of this month, we start our revision. Just read and read as much as you can, because the videos are, I'm the person who has done them. So you cannot tell me that I will not be able to watch them because you're not the person who is doing them. They are my videos, and I will be able to share with you. So I will share the videos for access. Then we shall see what are the changes in the ratio analysis, because I will just be able to do 2 past papers, and then we are ready for the exams. We are ready for the exams. So it is very critical for you guys to make most of the time to do your revisions. The materials are there. Materials are there. Unless there is any question, we can stop at that point.